So this is a model, to give you a background. This is basically from one of the training institute or education institute. I built a model. They were looking at a couple of courses to start off with, and then maybe increase the courses over a period of time. Right. So the model is very simple. It is they're teaching English language to various sets of students, and then they do it in a group of five people, right? So in a class you will have five people, and the other stuff is you will have seven people in the classroom. So different set of uh, two different sets of classroom that are there. And the company, they wanted to actually understand, if they invest a particular amount, in this case which is 1 million, how much are they going to get in terms of returns, how the cash flows will be looking at. They also wanted to present this to a investor. Obviously this is not a full blown model, because the client requirement was to just build a what we call our small working model, where they can play around with this, make small changes, and get to that. They wanted to build a model once they have raised some funds, or once the business is running. So this is the model that we created. If you see, there is a lot of data already filled up specifically into the income statement, but we will build from the revenue perspective, and then we spend sometimes on cash flow, balance sheet, and the valuation. Okay, so a couple of important points that you should know when you're building a model, or a couple of best practices in the financial modeling exercise. You see, we are working with multiple sheets, right? So if you are working with multiple sheets, then one of the key things that you should look at is that all the column referencing should be same across the sheets, right? So if you see, for example, column G is December 25, so column G will be December 25 in all the sheets, right? This helps us to have a consistency on the model. It also helps somebody who is trying to review the model to do it right. We will always build the model with the years in the columns, right? And all the details will be here, put in the rows, and the years in the column, not the other way around. Also, the other thing that you should be very clear when you're building a model is that, we have to utilize the full potential of Excel. So we try and build a model in such a way that whatever number or whatever formula we are putting in the first year, we should be able to drag that formula for all the years. So it should take the same time. If you are building a model for 1 year or for 100 years, it will almost take the same time, because once you have built a model with 1 year, and it is a consistent model, you will be able to drag it for all the years, right? All these things are very important. When you see a small model, it is okay here and there. If you have inconsistency in the formula, it is okay, manageable, because we can play around with that. We can go back and check that. But imagine there are models with 15, 20 sheets, which is going into hundreds of lines. Each of the sheets is going into hundreds of lines, and you make a small error in the model, and it is very, very difficult or almost impossible to be able to find out such errors. So when we are building the model, we have to be very cautious in what formulas we are trying to put in there. And in any inconsistency in the formula, we should highlight that in the for ourselves, so that later on, when we come back to that same model again, we know that this particular column, or sorry, this particular row or column, whatever is the case, has got some inconsistency. So we will work with that. Okay, so these are two or three best practices that you should know at this point of time for this model. Okay, so The other thing that we knew that you should do when you're building a model is to go as granular as possible. What do I mean by go as granular as possible? Is like this, I could have just forecasted the revenue on a broad basis, saying that ask the client what is the revenue, and then said that okay, this is the revenue will grow by X percentage over a period of time, and then this is what you will get. But we didn't do that, right? We are going to as detailed as possible in terms of how the revenue will be built up, what are the key drivers. Okay, the word I use is drivers, some people will call it as KPI, but you should go as granular, break up each cost item, each revenue item into small aspects. If you do that, the model becomes more robust, and then tomorrow if somebody wants to play around with those numbers, because this is all forecasting, right? At the end of it, things will change, we may have to build in scenarios. So if you have that broken up into smaller aspects, or what we call as drivers, each of the revenue, cost, and the other things also, if you're broken up into drivers, that gives us a lot more what do you say, flexibility. It also gets us to a better conclusion or a better output in terms of how we are looking at it. So try and break up things to as granular as possible. Obviously, there is the other thing that you have to think of is what is the client requirement also, right? So ideally I want to go as granular as possible, but if I go to a lot of details, some of the clients may not be able to handle that. So according to that, we will adjust, but going as granular as possible gets you a better output. Okay, so when I said granular, if you see how it is working out, so we have seen that okay, this company has told us that there will be 4 sessions in the whole year. So every quarter there will be session. Each session will have 200 students, but we're not going to teach all these 200 students together. We will put them into group of fives, right? We'll put them into group of fives, and then we will teach them, right? So we are, for the teacher cost also, there is separately for calculation for teacher cost, and then the training assistance cost, how that will grow is also given to us. So more detail is better, more detail is better. So that is the case. Similarly, when you go to the cost structure, we have put in the cost structure for each of the item, specifically because if you are doing an online business, then one of the largest cost for you, at least to start off, would be the marketing and advertising cost, right? So for the marketing and advertising cost, we are trying to build up from the understanding of how many students we require. From that, we are trying to say that okay, if we require X number of students, then how many leads do we require, right? And then what will be the cost to generate such leads. So we are trying to go as granular as possible. So that is the case. So let's get started. So the first thing that we will do is to calculate the revenues. It says there are 4 sessions, there are 200 students per session, right? So let me just start doing some calculations. So number of students per session into the number of sessions that are there, so that gives you how many students will be there. But we want a consistent formula, right? We want a single formula that can be dragged for the next year. Now to be able to do that, we need to take into consideration the growth rate, right? So let me put a number for growth rate. It is 1 plus this 10%, 1 plus this 10%. But obviously the growth rate is not going to be 10% in the first year. It will be 10, and then each year it is growing on the base of the previous year, right? So basically we will do power the number of years minus 1, right? So if you see, we've got number of students per session multiplied by the number of sessions multiplied by the growth rate, and power the number of years that is there, right? That is the stuff. Now to be able to drag it, we need to also freeze it, right? So I'm going to freeze the column C. I'm going to also freeze the column E, right? We need to also freeze the column or row 2. Yeah. So we've got 800, 880, and so on. But one of the other stuff is that all these numbers first cannot be in the in decimals, right? We are talking about the number of students, and then also, each batch is having 5 students, right? So we will round it off to the nearest 5. We'll round it to the nearest 5. So we're going to use the function mround. Mround this, comma, the multiple is 5, and then close the bracket and then drag it, right? So it is going to round off to the nearest 5, right? So the mround function helps you that. I am assuming that you all are doing it parallelly with me, because that is what is the purpose. I'll give you time to ask questions in between. Once I'm done with the revenue aspects, I will leave you to ask questions. Similarly, I'll keep doing that. So don't be worried if you have questions. Write it down, and we will answer that as we go along. Next is to calculate the revenue. Okay, so it is basically the number of students that are there multiplied by the fees per student, again multiplied by 1 plus the growth rate, right? So every year the fees is going to grow by 10%, power number of years minus 1, right? So again, what do we do? F7, number of students is there. C9, freeze the C, freeze column E, and freeze the row 2, right? I'm freezing the row 2 because I will copy the same formula down as well in the next section. So again, utilizing Excel to the maximum extent is what we are looking at. So that brings us to what is the revenue. The next thing that we have to look at is what is the direct cost, right? So there are two sets of direct cost, or two parts to the direct cost. One is what you pay to the teaching, for the teaching, and then what you pay to the teaching assistant, right? So in terms of how many sessions are required, so there is a group of 5 people that is there, and each group of 5 people, there are 48 sessions, right? Each group of 5 people, there are 48 sessions. So we will calculate the number of sessions, and based on that we will calculate what will be the cost for the teacher, right? So let's calculate the number of sessions here. So it is 800 students divided by the number of students per class, right? Multiplied by the number of sessions that is there, right? We need to freeze column C and column D. Column C and column D. So this is the number of sessions that will be done in the first year, and we can then drag it for all the years in terms of the number of sessions, right? And then cost per session is also given to us. Cost per session is also given to us. So number of sessions multiplied by the cost per session multiplied by 1 plus the growth rate, right? Power the number of years minus 1, right? So that is the cost per session. Cost per session. Let me freeze a few things because we want to drag it down. Mm, Let me not freeze the F11. C E2. Okay. Now, if you see, we've put this some kind of a reference here so that we can, once we have put the formula, we can just do Control Shift right arrow and take it till there, right? If it is for 20 years, 25 years, 30 years, then obviously the dragging becomes difficult. You cannot keep going, dragging one by one. So that is one of the other things that we do with a model. Uh, let's copy this formula down. It's not going to work, but so only thing that needs to change is this, right? So we've got what is the revenue from this particular product, and then obviously we've also got the cost for this, direct cost for this product in terms of the teaching cost. Right, now that we have built the formula, we've taken care of the formula, I think we should be able to replicate the same thing here. Let's quickly check. So works fine, except for we will have to round it off to the nearest 7. Okay, nearest 7. Revenue should be working fine. We can copy paste from here. Number of students multiplied. Okay, great, works fine. Similarly, in terms of the batch, we should be able to copy the formulas. You know, if you are confident with this, you can just copy it all together, not be worried about one by putting it one by one. So that is the number of teaching sessions, and then we'll also copy this one. Yeah, let's quickly check, because okay, works great. This is what we have got. The total revenue, total costs are there. We will do the next aspect, which is to go to the income statement, and first thing that we will do is to calculate the marketing cost, right? Specifically, which is the lead generation cost. We've already been given 1 million of cost that is there for one-time marketing cost, but we'll also have to generate leads. So if you look at how many students are we going to enroll every year, this is the number of students that we need to enroll every year. So if you are enrolling these many students, then how many leads are required, right? So for that to understand, we need to have something called as conversion rate. So what is the conversion rate? So it's basically telling us that if 100 people are inquiring for our course, 1%, which is 1% will be joining the course, right? So to be able to get to almost 2000 student, right, to be able to almost get to 2000 student, you would need 20,000 leads, right? So that is the conversion rate. But as you go over a period of time, you will see the conversion rates increasing, and as the conversion rate increases, you will spend less and less on the marketing aspect, right? Less and less on the marketing aspects. um, I will also take a few minutes here. The blue color numbers that you see, that is what we call as our assumption. These are assumptions not necessarily given by the clients directly. For some of the assumptions, we do research. For some of the assumptions, we sit across with the clients to understand how their business works, what are the key drivers for their business, and then come to a conclusion that, okay, these are the things that we will be required, or these are the important things that are required while building a model. So we sit across and do this. This was comparatively easier for me because obviously I've been in education for about 9-10 years, so I know how the system works and how things work. So didn't spend a lot of time with the client, but yeah, for any model that we build, we initially spend time with the client, understanding the business of the company, the business model of the company. We spend time doing that, right? So once that is done, then we get into these numbers. Okay, so Number of leads required, we've got that. So what will be the total lead generation cost is this multiplied by this, right? So that is the lead generation cost for us. If you see over a period of time, obviously the lead generation cost is coming down substantially, right? Because as your conversion rate improves, this is becoming a better feasible, more feasible business for you, right? So that is there for the marketing cost. The next thing, the marketing cost is already linked here. Advertising cost is already linked here, so we need not do anything about that. But the only other thing that we need to be worried about or to calculate here is the IT personnel cost, right? So we have been given that we would require 2% or 2 IT person. The cost will be 10,000 per year, and then their salary is going to grow by 10% every year, right? So number of person multiplied by the number of what is their salary multiplied by 1 plus the growth rate, power this minus 1, right? First year there should not be any growth, right? To be able to drag this, we also need to freeze column C, we need to freeze the column D, we need to freeze column E, and we may as well freeze the row 2 if we want to drag the same formula elsewhere. We may just do that. So that is your uh, IT cost, that is there, IT personal cost. With this, we've got the income statement. A good thing or a bad thing, whatever you call it, is that there is no interest, and then there is no taxes for this particular company. So the geography in which this company is working, there are no taxes on education. There's no interest, obviously, because the company does not have debt, right? So one more aspect that we are going to miss out on this particular model is how to build a debt structure, or how to build a uh, debt template, right? If you were to look at that, you can again go to our website, go to our YouTube channel. I think a couple of weeks back we did one session on how to build a debt schedule. That was for project finance model, but it is equally applicable for any model, so you can have a quick look at that. Okay, so that is the stuff here. This is what we have in the income statement. One more aspect on the income statement, which is the depreciation, is going to come from the balance sheet. So we will, once we have forecasted the balance sheet, we will have these numbers here. Okay, next is to get to the balance sheet, and the balance sheet number here is where your understanding of accounting and the linkages will come into play. So the share capital is whatever share capital was there earlier, plus whatever new capital you are coming. Again, it's a simple model, right? So we have just put the new capital directly into the cash flow. So whatever previous number plus whatever is getting invested now, right? Getting invested now. In this case, only one investment is being done, so that is why you see the shareholder capital a million every year. Next is the reserves and surplus. This is basically your retained earnings. So how do you calculate whatever is the retained earnings plus whatever is the profit for the year? Profit for the year, right? Profit for the year. Um, that is the reserves and surplus, right? Reserves and surplus. If there was any dividend, then we had to adjust that dividend here. Next is in terms of the current liabilities. There is only one item in the current liability, which is the payable, right? And we have been given the payable days, right? Payable days is given to us, so we will do that. Now here they've not specified in terms of which costs are going to be paid with a lag of 15 days. So we will assume all the costs will be paid with a lag of 15 days, and we will do it in the total cost. So I'm going to say the direct cost plus the operating cost multiplied by the number of days divided by 365, right? Divided by 365. And we'll need to freeze this column E. Yeah. And we can drag it. It's basically the payable days are given to us, right? So from the payable days, we have calculated the payables. So this is what you have in terms of total liabilities and equities that is there in the model. Next thing is to look at the fixed asset. Again, for a fixed asset, we typically create a schedule, but in here, the fixed asset schedule is very simple, or at least looks very simple. We've invested $1 million, right? Assuming that all of it is spent on some kind of a asset here and there. And we are capitalizing that particular asset. We are going to put the gross fixed asset. The gross fixed asset is equal to this million, right? Whatever money was there has been put here. Now this is one inconsistency that we will have in this model. So for me, I will just right click on that, insert a comment, and say inconsistent formula. Okay. So this, and then obviously the gross fixed asset is going to be whatever was the fixed asset, or I can actually just have this like this: last year's gross fixed asset plus, actually minus this number. Okay, so that's the gross fixed asset that is there. Okay. The next thing is the depreciation. Again, we've not been given any information as such about the depreciation, but the depreciation is going to be for 10 years, right? So we are assuming that this life of the asset is 10 years. So uh, each year you will have 1 lakh rupees of depreciation, right? So the accumulated depreciation is whatever is the last year's depreciation plus this divided by 10, right? And we'll just put a minus sign at the start. What am I missing out? Okay, this is already a negative number. Okay, so that is the accumulated depreciation. As I said, we don't generally do it in here. We will have a separate schedule for it, but this is what we can do at this point of time to get the depreciation, and we can quickly check if this is correctly flowing onto the income statement. It is correctly flowing into the income statement, 1 lakh every year, and it is getting deducted from the EBIT. Okay, great. So that is about our balance sheet. The cash in the balance sheet, the cash in the balance sheet will come from the cash flow statement. Again, I'll take a quick pause here. Check with you guys if there is any questions. In the normal classroom, what we do is people are unmuted, and then you can ask your question as and when it comes. But with the webinar with large audience, it is difficult to do that. Okay. Any questions? Rohit, there's background noise from your side. Okay, thank you. Okay, guys, I will continue assuming there are no questions here. Okay, so as I said, the cash in the cash flow statement will come from, sorry, cash in the balance sheet will come from the cash flow statement. So once we have linked the cash flow statement here, once we have linked the cash here, we will get um the balance sheet will be tallied. Okay, again, a very simple cash flow statement. We've got the profits, we have got to add the depreciation. So profit for the year from the income statement, right? Add depreciations, so you will add depreciation, the depreciation. We need to get the working capital changes, and we only have one item there, payables. So basically, let's go to the balance sheet, and here we will have to just work out with a in the first year. In the first year, let me do this. Let me move it. I will just move this here. Okay. So balance sheet, the cash flow payables is equal to the current payables minus the last year's or payable, right? That is the changes in working capital, right? With this, our cash flow is also done because the other linkages were already there with us. There's no debt for this company. Net cash and cash balance are already there. We just need to link our cash flows. From the cash flow, we need the cash balance here, right? So once you link this, oh, what happened? They linked the wrong number. Yeah, sorry. Closing balance, row number 19. So once you link this here, then your balance sheet is now tallying. So we have this check here on the balance sheet, which tells us whether our balance sheet is tallying or not. So if you look at this case, the balance sheet is now tallying after you've done this. So this is what you need to know. So if you obviously we didn't build the complete balance sheet, the complete cash flow here. So if you have a detailed cash flow, you should be able to understand how the two statements are linked. We do not want to spend a lot of time just understanding how the linkages are working, because that is not something that we need to that is expected from you. So we've linked the statements. We have got all the things that is required. We will finally now do a the valuation, right? In this case, the valuation is more like a project model. We are not going to do a DCF valuation. What we are doing here is more of a calculation of NPV IRR, right? So to calculate that, we need obviously the operating cash flow, right? Operating cash flow from the balance sheet we have. Sorry, from the cash flow statement, the operating cash flow, right? The capex is already given to us. That is there. Uh, so we are taking that. The other years you can link it here, but not a requirement to look at it. And then finally, you know, when we are doing the free cash flow to the firm, we've added them, right? We've added them. The NPV formula is already there, but we will maybe change that formula or put the formula. So to calculate the NPV, what we need to do is uh, we need a rate which is already calculated. Cost of equity is given to us, that is calculated, and then what we need to do is add up all these items, right? So it will calculate the present value of all these items, plus separately add up the item that is here which we don't discount, right? So that gives us the NPV. We can also calculate the IRR, right? So the IRR, the return from this particular project is turning out to be 32.8%. The expected return from this is 29.9%. 29.9%, right? So uh, the cost of capital, obviously part of it is coming from the capital asset pricing model, but there are two aspects which are here. If you look at the formula, you will see that there is something called as because this is a small company, startup company, right? So the somebody investing in the equity of this company will not have any marketability, right? They cannot liquidate that in the market. So they will ask for a premium, or they will put a premium in terms of the return expectation. Similarly, because it is a small company being run by a few people, we don't know how the management is there. So on top of whatever equity risk premium is there for this particular set of business, we are putting in more premium for that, right? So that is how the cost of equity is built up. Apart from that, these are part of the capital asset pricing model. It is RF plus this is beta, and then you've got the RM minus RF, which is called as the equity risk premium. Like all these values we have taken from the in fact, these two values we have taken from Mr. Ashwath Damodaran's files that he updates every year in January, which has got the beta, equity risk premium, and a lot of other things. So we have also put in the link. You can look at that from there. Now after building the model, it's not just building the model. We also sit across with the client to look at various scenarios, various things that happens in that model. What happens if we change a certain aspect in the model? That is what they do. So one of the things that clients ask us to do is do some bit of sensitivity analysis, right? What is sensitivity analysis? So they want to understand the impact of change of certain items on the valuation, right? So in this case, what the client wanted to ask us, or what the client said, is that because you've put these two kinds of premium here, um, uh, what will be the impact if the premium is going up or down? What happens to my NPV? That is what they wanted to understand, right? So what we have to do is to do a sensitivity analysis. So in Excel, if you have to do the sensitivity analysis, we use data table, right? That is what we are going to do. So to do the sensitivity analysis, first what we have done is we created a structure, right? Which is like currently your company specific risk premium is 20, but if it is 15, then what? If it is 10, then what? On the other side, it is 25, then what? If it is 30, then what? You can have any number here. This is yeah, and you need not have every time 5 plus or 5 minus. You can have any number that you want to input here. Similarly, we have done the same thing for the discount for lack of marketability, right? So to do the sensitivity analysis, the first thing that we do is to link this to the top corner. We link the number on which you want to find out the sensitivity. So we want to find out how sensitive is my NPV to changes in these two items. So I've linked my NPV here. Then once that is done, then I will select the whole table, control shift right, control shift down. Once you've selected, then you go to data. Under data, go to what if analysis, and under what if analysis there's data table. So you click on data table, and then it says row input cell, right? So on the row we have got something called as company specific premium. Company specific premium. So I'm going to select this. On the columns, this is the columns. On the columns we have got the column. On the column we have got the discount for lack of marketability. So I'm going to come here and discount for lack of marketability and say okay, right? So if you see here, um, it tells you in a single table, what happens to your NPV, or what happens to your I should not exactly call it returns, but what happens to the returns from this particular project if the company risk premium or uh, the uh, the lack of discount because of lack of marketability, all those premium is going to change. What happens to your returns, right? What happens to your returns? So outrightly we can say that here the NPV will become negative, right? So equity risk premium or company specific premium of higher than 20, it seems that the NPV is going to go negative, right? So that is what is going to happen. Similarly, in terms of the marketability, the lack of marketability, um, that stuff, it is fine at various levels, but it is this one, it seems that the company specific premium is having a larger impact on the NPV than what is the impact coming out from the discount for lack of marketability. So you can create such sensitivity with various other numbers that are there in the model, but there are a few things that you need to know here. If you are doing the sensitivity analysis, first is you can only take two parameters, right? One on the column, one on the row. You can only take two parameters. The other thing is that the parameters that you take here, you have to create the sensitivity analysis in the same page. For example, if I wanted to do a sensitivity analysis, if I wanted to do the sensitivity analysis for, let's say, um, the revenue per student, right? I wanted to do for this one, revenue per student for this particular course. I can do that, but the challenge is that I cannot then put the valuation here. I will have to take the valuation to that particular sheet, and then all the numbers which are getting linked here, right? Which is, one is the number on which you want to do the sensitivity. Second is the two things on the row and column. All of them have to be in the same way, on in the same page. Otherwise, the sensitivity analysis is not going to work out.